On November 13, 2024, China's Minister of Finance landed in Riyadh. He didn't come to sign a deal with Russia. He didn't come to talk about yuan or BRICS. He came to do something far stranger, to sell Chinese debt to the Saudis in dollars, with Goldman Sachs as the middleman, and the Saudis bought so eagerly that for every dollar in bonds China was offering, $20 showed up wanting in. Think about that for a second. The country that has spent 2 decades leading the global anti-dollar narrative just issued debt in dollars in the capital of Saudi Arabia, using the same Wall Street banks that built the system it supposedly wants to destroy. What kind of war against the dollar is that? The answer isn't what you'd expect. And once you understand it, you'll never look at the global economy the same way again. To understand what happened that November, you first need to understand how the system China supposedly wants to replace was actually built. We go back to 1974. Nixon had broken the gold standard 3 years earlier. Oil prices had quadrupled. The United States desperately needed the world to keep accepting its dollars, now that they were no longer backed by anything physical. Henry Kissinger boards a plane. Destination: Riyadh. The deal he negotiated with King Faisal was simple to the point of elegance. Saudi Arabia would commit to selling its oil exclusively in dollars, and with the dollars it earned, it would buy U.S. Treasury bonds. In return, modern weapons and a guaranteed military umbrella. The petrodollar had been born. But there's a technical distinction here that most media never explains, and it is the key to everything that comes after. The system had 2 separate pieces. The first piece was denomination, in what currency was oil priced. The answer was the dollar. The second piece was recycling, where those dollars went once Saudi Arabia collected them. The answer was also the dollar, but in the form of treasury bonds sent back to Washington. Think of it as a 2-segment pipeline. The first segment pushed dollars out into the world every time someone bought oil. The second segment pulled those same dollars back to Washington when Saudi Arabia bought American debt. 50 years, the same circuit. The water always returned to the same reservoir. That gave the United States something no country in history had ever had: a massive, captive buyer of its own debt. It could borrow more cheaply than anyone else on Earth because there was always someone on the other side buying. And above all, it had sanctioning power. If treasury bonds are the heart of the system, controlling those bonds means controlling the system. Now comes the part nobody talks about. While China was building its anti-American narrative, it was doing something completely different in private. It was feeding the dollar system more than anyone else. When China joined the World Trade Organization in 2001, it became the factory of the world. American and European companies paid for their orders in dollars. Those dollars landed at the People's Bank of China. And what did China do with them? Exactly what Saudi Arabia did. It bought treasury bonds. By 2014, it had accumulated $3.2 trillion in reserves. The loudest critic of the dollar was, in secret, its best customer. But there was more. China's provincial governments needed to finance highways, subways, and ports. And it was cheaper for them to borrow in dollars than in yuan. Today, there are $500 billion hidden inside those balance sheets. The Beijing-Tianjin Expressway, the subway systems of Chongqing and Wuhan, the special economic zones of Shenzhen, all of them carry American dollars in their books. And then there were the tech giants: Alibaba, Tencent, Baidu. The Chinese government prohibits direct foreign investment in technology, so its companies invented a workaround: create a shell company in the Cayman Islands, list it on the New York Stock Exchange, and have that shell company sign a contract with the real company in China to receive its profits. The Wall Street investor thinks they're buying Alibaba. In reality, they're buying a piece of paper in the Caribbean with a contract whose legal validity under Chinese law is To be generous. Debatable. In offshore dollar-denominated bonds alone, the outstanding stock exceeds $720 billion. 20 years. Anti-American speeches at the UN in the morning. Dollar-denominated debt in the afternoon. The system began to crack, not all at once, in 3 distinct fractures. The first came in 2016, with a law passed by the U.S. Congress that allowed families of 9/11 victims to sue the Saudi government directly in American courts. The problem? If that law were applied, any Saudi asset on American soil, including treasury bonds, could be frozen by a federal judge's order. Saudi Arabia threatened to liquidate $750 billion in American assets. It didn't follow through, but the message was burned in permanently. Treasury bonds now carried a political risk they had never carried before. The second fracture was more violent. February 2022, Russia invades Ukraine. Within days, the United States and the European Union freeze $300 billion in Russian central bank reserves, the largest confiscation of sovereign assets in modern history. Every central bank in the world drew the same conclusion at the same moment. If they can do this to Russia, they can do it to me. The third fracture was slower and nearly invisible. Mohammed bin Salman launched Vision 2030 and began redirecting Saudi petrodollars toward domestic investment. The money that once went to treasury bonds started staying home. 3 blows, 1 legal, 1 operational, 1 strategic. The 1974 agreement was dead. It just needed a death certificate. The certificate came on June 9, 2024. No press conference, no joint statement. Saudi Arabia simply let the agreement expire and began accepting payments in yuan, euros, rupees, whatever currency the buyer put on the table. But here's the crucial part. Oil kept being priced in dollars. Gulf states kept their currencies pegged to the dollar. Sovereign wealth funds remained massively invested in dollar-denominated assets. What died wasn't the currency, it was the pact. And in the gap between the death of the pact and the survival of the currency, China saw an opening the size of a continent. 5 months and 4 days later, Riyadh. China's Minister of Finance comes to market with a $2 billion sovereign bond issuance. 2 tranches at 3 and 5 years. Yields almost identical to equivalent American bonds. The spread was 1 basis point, meaning investors considered Chinese sovereign debt exactly as safe as American debt. The issuance was 20 times oversubscribed, $40 billion wanting in for a $2 billion offer. Most of that money came from the same Gulf sovereign wealth funds that had spent 50 years buying treasury bonds from Washington. The details matter. Beijing could have chosen London, Singapore, Frankfurt, or Hong Kong. It chose Riyadh, the same city where Kissinger built the system now being replaced. The banks that ran the deal were Goldman Sachs and JP Morgan, the same banks that for half a century had organized Saudi purchases of American debt. The same people who built the old system were now building the new one, collecting fees from both sides. That was Sino-dollarization, and it is probably the most elegant financial maneuver of the last several decades. So what exactly does it consist of? Remember the 2 segments of the pipeline. China understood something its rivals missed. It cannot compete on the first segment. The yuan accounts for 2.5% of international currency use. The dollar accounts for 49%. That gap doesn't close in a generation. So China left the first segment untouched. It doesn't fight for denomination. It doesn't try to price oil in yuan. It would lose that battle. Instead, it went straight for the second segment, the recycling. And it said, the dollars you earn selling oil, instead of sending them to Washington, send them to me. I'll give you the same return, but with one difference. These bonds are outside the reach of any American federal court. No judge in Washington can freeze them on a Tuesday morning because the political winds shifted. The flow stays in dollars. What changes is the destination. China doesn't destroy the pipeline. It builds an alternative reservoir at the end of it. And where does China get the dollars to pay its bondholders? From the same dollars it has spent decades accumulating. From its export surplus, from offshore issuances, from the balance sheets of its companies listed in New York. By the end of 2025, China has $28 billion in outstanding dollar-denominated sovereign debt, a small figure compared to the $34 trillion in U.S. Treasury bonds outstanding, but enough to prove the model works, and models that work tend to grow. Now, this system has a ceiling, and that ceiling is called the capital account. For a currency to be a true global reserve currency, it needs to be bought and sold without restrictions. Investors need to be able to move money in and out whenever they want. That means opening the capital account. And China is not going to do that. It watched in 1997 as the Asian financial crisis destroyed the currencies of Thailand, Indonesia, South Korea, and Malaysia within months, after those economies opened their capital accounts to international flows. Those currencies lost between 50% and 80% of their value. China, with strict controls in place, made it through without contagion. That lesson is written into the DNA of the Communist Party. The capital account stays closed, and that means the yuan will never replace the dollar as the global reserve currency. But here's the trick that makes the whole play brilliant. China doesn't need the yuan to win. Sino-dollarization works precisely because it doesn't try to solve that problem. It uses dollars. It builds power inside the dollar system. And meanwhile, in the margins, in the bilateral corridors with its emerging market partners, it quietly installs yuan infrastructure. The CIPS system as an alternative to SWIFT, the M-Bridge project for digital payments between central banks. Two plumbing systems running in parallel, one public and dominant in dollars, one private and growing in yuan. Saudi Arabia already operates in both simultaneously. Nobody in Riyadh is choosing between one system and the other. They're in both, and that, precisely, is what strips Washington of the most powerful weapon it had. What China has achieved with this play is not weakening the dollar. It's something more precise and more dangerous for American power. It has broken the United States monopoly on recycling. Before, if you wanted to store your dollars somewhere safe, there was only one place: Washington. Now there's an alternative, and that alternative has no track record of freezing sovereign reserves on a Wednesday because its foreign policy changed. When people talk about the end of the dollar, they picture a cinematic scene, a BRICS summit, a new Bretton Woods, the moment the world says it's over. That's not going to happen. What's happening is slower, duller, and far deeper. The dollar is still in place. Oil is still priced in dollars. International contracts are still written in dollars. But the pipeline that used to return all those dollars to the same reservoir in Washington has fractured. Because for 80 years, America's real victory wasn't that the world used its dollars. That was the visible part. The invisible part, the one that truly mattered, was that those dollars always came back. Always. Recycled into bonds, into equities, into real estate. But somehow, the money always found its way back to Wall Street. That is the part that just changed. China didn't win the war against the dollar. It did something smarter. It stopped fighting it. It learned the rules, stepped inside the system, and is now competing from within on the only ground where it can win. The United States built the board. China memorized every piece. And now it's playing the same game better than the one who invented it. Can China build the credibility it needs to make this last? Leave your answer in the comments. See you in the next one.